Hey everyone, welcome to Options with Hans. I am Hans Albrecht, of course. I was a pro options market maker for 15 years, trading long option strategies, short option strategies, income, leverage, everything in between. Fantastic time. Then I ran a whole bunch of option income funds and downside protect funds for a decade after that, generating $750 million for investors, members, clients around the world. As always, this is your trade, your responsibility. So if you're okay with that, continue on and let's learn a couple of cool things. Today I want to talk about markets in general, a little bit of what I'm seeing. I want to do a longer video on this soon, and then we're going to sort of jump into the JPM Collar just a little bit. I'm going to show you a little bit of how a market maker kind of does his job. Everyone talks about gamma and they talk about support and acceleration from gamma and vega and charm and all these kinds of things happening out there. And this gets quite pronounced around these strikes within the JPM Collar. Now, you can see a big series of videos that I did on the JPM Collar. If I'm going to put those on the screen here, as well as down in the description, and you can learn a little bit more about that. It's actually a really good chance for you to learn about how a market maker does his or her job, and how those Greeks come into play and all that. Today, I just want to kind of talk a little bit about what we're seeing out there. It's been a little bit on the quiet side, of course. It's been like that for a while. We've seen 1 month realized volatility, which was actual movement in the sort of almost mid single digits. That's a little bit unusual. We see that sometimes on the 10-day, but really it's been very, very quiet. And the market, as we've seen again this week, we had a little bit of a sell-off and we bounced right back again. And of course, there are very good reasons for that. We're going to talk about some of those today. I've been sort of yelling about a lot of this stuff for a few months now, and it's sort of playing out as expected. I want to tell you a little bit about Skew. So why is it so quiet? Well, because we have this environment where the market is very well bid, sentiment is quite negative, and really there aren't enough people believing in this rally. And I'm going to show you a couple of charts in a moment that are really kind of eye-popping. You kind of don't really see this very much. So, and we'll talk about the sort of texture of this market, which is very, very curious in a way. I haven't seen anything quite like it in my 3 decades. And so, but for the market, for the Fed, this is kind of warm porridge, right? We've gotten some pretty good retail numbers. Inflation came in okay. So really the focus is still on that jobs front. And that kind of leaves us with sort of essentially what we see as a strong economy, weakening jobs, and inflation that is no longer a really, really big concern. Now, it might be at some point if what I think plays out actually continues to juice the economy, but it is going to be kind of a little bit of a bifurcated market, and I'll show you a little bit on that. And then we'll talk a little bit about that collar support. I'm going to show you how that market maker really treats that and why that sort of level of 65.05 is really support. How'd that work, right? So we look at this. S&P 500 posts the longest losing streak in a month. So all the bears got really, really excited again. But as I've said for a long time, this is going to be the kind of a market where the sell-offs can be 1.5%. Maybe you might get somewhere down around 2% on the market from the highs. Probably not, but it is a vol clustering kind of market, right? So markets more than ever, I remember back in the 90s, the 2000s, even to early 2010s, you had this ability for the market to stay volatile for a while. Now it's either all hell's breaking loose or nothing's going on. And so there's really this kind of volatility clustering that is influenced by a lot of the kinds of funds out there, the CTAs, the vol targeting, option selling funds that kind of create more of a clamp on markets as well because they replenish the market with all this positive gamma, which means things kind of slow down a little bit. So PC numbers, good, as expected, paving the way for a rate cut. And so we saw that rate cut kind of bump up just a little bit more now, right up to 90%. We were down a little bit. We had those good retail sales, but we sort of been playing this little game of ping pong here, whereas they were really, really quite sure of it. And now that sort of, and we see the long bond, which I think is probably a little bit of a short here, kind of come down and sort of stabilize a little bit at those levels. I got out a lot of my TLT around 90 and a half, that kind of area, out of some calls, which did really well in Leaps Trader as well. So we've had this move here, and I think we're kind of we're at the stage where you have to be able to pivot very quickly, right? So you guys might remember, if you watch some of my public shows, I talked about how, Upwork and Fiverr and things like that were kind of shorts because of this impact that they're gonna suffer from AI and AI being able to do so many things. So I shorted those, made some money, and then at some point I said, well, wait a minute, this is actually kind of good for a number of reasons. And I got super long Upwork. In Leaps Trader, we made a whole bunch of money on that. And so the ability to get back in, because these companies are now going to be generating significant amounts of revenue from people going out and trying to get stuff done with AI, because it's just not that easy button anymore. So there's sort of the interesting trades, but you got to really kind of pivot and switch when you see these narratives kind of turn around a little bit. So you got to be on your toes in this kind of market, because we're going to see disruption on a level that we've never ever seen before. This is quite simply going to be a time that nobody really quite grasps yet. And I think that's what's kind of interesting about it. We'll talk about that skew in a moment. So we can see here that this is the famous chart of, well, let's look at the different cycles. So if we get a rate cutting cycle into a recession, well, then eventually, it doesn't really do very well. And if we get a rate cutting cycle not followed by a recession, then we get this beautiful run in markets. This is my base case scenario. I believe this could turn into a roaring 20s type scenario, which I've been calling for 1,000 points now. I said, this is going to get very positive. Inflation is going to run out of steam. Although I'm now thinking that maybe it has that ability to kind of stay a little bit sticky, because you can't have everything, right? You can't have this incredible boom and plunging inflation, quite probably, because you do have the requirement for inputs. As we see this infrastructure build out, it's going to require a lot of things out there. Then the power generation needs, that's going to spread to everywhere. And I'm going to start a series on those sort of non-negotiable areas like rare earths and power and semiconductors. There's little ways that we can dig deep into those areas and find things that really kind of have these amazing tailwinds for the simple reason that we are in America cannot lose. And we cannot rely on, for example, semiconductors being made 100 miles off the coast of China, and we cannot rely on China controlling rare earths and things like that. So this is a new world. Everyone kind of crapped on me. I put out a video on Intel, and they made fun of me left, right, and center. And guess what? The stock's up, 50, 60% since then, and they've all gone quiet. So it's not that it's a massive turnaround. It's that you've got to understand what's happening out there. Intel cannot lose. It's not going to be an NVIDIA or an AVGO or Broadcom. But it cannot lose. And that's why you have to look at things from a very different lens at this point. Very different lens. So we can see here, we're crushing those options. This is the term structure in volatility, crushing everything as we get going here. And then, of course, we start to price in a little bit longer. What did I say? Over the last month, 6 weeks, I said, longer term vols are way too inexpensive. I said on one show, I said, if I were running a massive vol fund, I would be all over these longer term vols. They're stupid cheap because of the way things are about to change. You cannot price what is happening out there. How do you work in, if you're an analyst, you are probably clued out at this point as far as AI is concerned, but how do you start to price in the possibility that productivity gains from AI, these tools, these benefits, could absolutely completely retool the way companies are doing, which has an implication for profit margins, for what they can accomplish, for new kinds of businesses that they can get into because they've created more resources that can now be deployed elsewhere. You just don't know what this means for the economy. And that requires, even if it's a positive thing, that requires that option prices start to reflect some of that uncertainty, that upside volatility, as well as the potential for something to break at some point. So there's always a little bit of upside downside, but that's what options are trying to encapsulate, the potential for movement. And that's what we have to recognize. Now, early this week, we saw this pullback on Tuesday, Wednesday, a little bit Thursday, and yet we saw fixed strike vols come down. That's always one of those nice little tea leaves that I like to read. You see markets coming off and fixed strike coming off. That's because the parabola, that's the sense that, I'm going to tell you a little bit more about it, and everyone's kind of confused. Well, why is volatility so crazy, right? Like right here we go, alpha. There's no precedent at all to the combo of the S&P at all-time highs 1 month realized vol of 7 and the VIX at 16. So what does that mean in plain English? Well, the VIX is pricing movement of 16. So let's say that's about 1% per day over the next 30 days. Realized volatility is 7. So the difference between those two, think of this as the insurance company is charging you 16 for a policy that's really only worth 7. Right? So they're charging you a whole bunch more than what the policy's worth. Now, these should not have a massive, massive gap at all times. Now, they can diverge, which we're clearly seeing here, but they should have a relationship to each other, right? That's how pricing works. It has to kind of have some relationship to risk. And right now, this is a little bit like we saw last year in the election. And he says here, look, there's no event on the calendar like last year's election. We saw that very same thing. We saw very, very quiet markets going into the election, even though the VIX was pushing 19, 20, 21, 22. It was very high versus the underlying movement. But there was a very good reason for that, is because we had uncertainty surrounding the election and what might transpire, and disputing the election. All these things represent uncertainty, and risk markets have to price that in. We have this massive, massive spread between what the market is charging and what it's really worth, in a sense, what those contracts are worth. Yet we don't have any kind of big event coming up, and everyone's kind of trying to postulate, well, what's going on here? We see this very steep contango, very kind of calm contango. This is a very positive picture on the VIX futures, yet we have this very, very big divergence here. We call that the volatility risk premium. You're really charging people a lot for that insurance. Guess what? It's because of what I was just talking about, in large part. Because we are entering into the market. Remember, markets just have this amazing way to forecast things. So I'm going to show you sentiment in a moment. Sentiment is terrible. It's as terrible as it's almost ever been, with markets pushing all-time highs almost every day. How can those things be so different? How can people be down in the dumps from a sentiment standpoint, yet the market keeps pushing up? Because the market just has this ability to sniff out what is really going on there, and it's playing out in pricing. In pricing in equity markets. We're starting to see parabolas happen. We've seen some parabolas come back down, things like Oklo and things that have gone bananas and come back down. That may not be the end for them, but those are unique examples. We could see that continue to spread. I've been showing a chart last few weeks, over the last month, that shows how that upside inverted skew, that call skew, is starting to get really kind of excited. That's what we've started to see, right? So part of this is that downside put skew coming down as people, relative to the upside call skew, because people are starting to get nervous. I'm going to show you an example of that right here. Here you go. So here's your Amazon. This is where I was saying this is just getting crazy. These are so cheap given what could very well happen. So here's Amazon pumping up a little bit here. I still don't think it's all that expensive, but look, we've come up here from basically 0 percentile, 3, 6, like nothing, up to about, maybe an average between percentile and rank of about 40, let's say 42, something like that. So nothing, still not crazy. But it goes for almost all these stocks. Like, I'm looking at all these things. I mean, of course, if you look at 30-day or, depends when the earnings are, of course, those are going to incorporate earnings, but these are longer term option prices. Look at this, boom, right down from 28 to 32. That doesn't sound like much for vol points, but in the world of 1-year options, that's a reasonable amount. You can see that's a reasonable amount compared to the normal movement you see in these longer term options. So these stocks are starting to price in the probability of exactly what I've been talking about last few months, which is that things are going to go parabolic. They're going to look a little bit like 99, 2000. And I think we're sort of early on in that cycle. Now, does that mean that stocks can't pull back? Of course, we're a little bit overextended at this point. I think we can maybe pull back 3-4% at some point, but I kind of have my doubts because we've ignored seasonality almost completely at this point. And sentiment is just so negative that there's just so much more potential buying to happen. That's why you rarely see stocks stay down for more than a few days, really for more than 1 or 2 days. We just had 3, and that's a very unusual thing. And of course, the bears get excited again, and then they just jam them right up to all-time highs, as we saw in the S&P. So look at this. You've got look at this output versus employment Just this is what you have to understand, that you can't use. Visser talks about this. You can't look at things the same way you looked at them 20 or 40 years ago. So many economists are out there just not talking about the important things here, which is how this is happening, right? So look at output. This is technology. This is AI. This is going to get worse. And here's employment really not going up as it did before, right? During COVID, we had technology take off, but we also had a commensurate sort of move into needing people and hiring people. That's not happening as much anymore. So there's definitely going to be a longer term repercussion, societal repercussion from what's happening here, because a lot of people have to kind of sort of retool and reinvent themselves. And certainly, graduates are, the higher education area is in complete turmoil, or is certainly about to be. I mean, in complete and utter turmoil over the next couple of years, as they realize they are completely irrelevant if they don't start to do things that actually make sense for young people coming up and entering the world. So it's really, we're going to see a complete revolution in the way that we look at these things. The sentiment, they talked about this on Moonshots, the sentiment for higher education is absolutely plunging, and people are upset. So the younger generation's upset. I'm not saying there won't be a societal impact and pushback at some point, but right now you have to understand that this means that Wall Street and Main Street are no longer the same thing, right? That we know that they haven't been for a long time. They're going to continue to move apart as the asset holders. I don't have the chart with me, but you can see that retirees are controlling much more of spending than they used to, much, much more. So there are people out there controlling more of the 70% of the economy. It's 70% driven by consumers, and more of that is in the hands of people who own stocks, who own businesses, who own homes, who own artwork, who own comic books. I mean, this is really a Main Street, Wall Street divide that is just going to continue. Look at this. You've got bifurcated in terms of what people are spending on restaurants. Look at restaurants are doing just fine, but at the low end, we're just seeing flatlining here, right? So this is very modest growth compared to the people who have money. So again, people who have money and assets and who feel flush with wealth versus the people who struggle, who are renting, who are now having trouble finding jobs. There is a very big there could be a big problem at some point here. Let's look at the sentiment. I told you about this. Sentiment is terrible. It's terrible. You don't ever see this with, and look at Goldman. They say basically none of the 9 positioning measures in their sort of complex of indicators is in stretch territory. So as this market makes new highs and everybody's sort of sitting there going, this is a bubble, I don't know what's going on, stocks have gotten too high. Have stocks gotten too high? Rates going to come down a little bit, and profit margins are absolutely about to get juiced. I'm going to talk about Goldman in an upcoming video, how we just absolutely nailed that in Leaps Trader. We've trimmed a little bit, but we're going to be adding more convexity to the upside because finance companies are absolutely in the perfect position to take advantage of AI, and then not to mention the IPOs, the deal making. This writing's been on the wall for a while. The CEO came out months and months ago, February, I think, and said we're saving tons of money on AI, on our costs because of AI. Like this is not a secret. You just have to read what is going on out there and understand how big this inference stage is. It is absolutely massive. We are going from this training phase that really benefits that's hyperscalers, the handful of companies like NVIDIA's and Broadcom's, et cetera, to an environment where we are going to start to spread the wealth. And that's what makes this a potentially absolutely kind of mind-blowing potential for the broader economy to really take advantage of that. So you can see here, I look at this guy, I totally envision a quick rug pull. I don't know if he's talking about just a few days or some sort of big crash. I mean, some people are calling for a crash. I was watching some Kalanovic today. I mean, that guy has no clue what's going on. How do you go an entire episode with barely mentioning? I mean, he mentioned AI a couple times. Like, how do you do that? You're living in the past, man. You're living in a different era if you are not looking at things the right way. So this is not the most hated rally. In a sense, it's the most misunderstood rally that I've ever seen. And it's hard to price, right? How do you price that? How do we price the market going forward when profit margins are they're probably going to absolutely get juiced. I'm going to show you guys in another video a few reasons that make me think that they're about to start getting going in some of the broader economy. So I hope that was interesting to you. Now I want to show you just a little bit about this JPM Collar. So what happens is I'm going to draw you a little bit of a picture here, or at least in text. So let's say at the 65.05 level, the market makers are long 100 calls, right? Let's say a market maker's long 100 calls at the 65.05 level, which is let's make this SPY, right? 650 SPY, market makers are long 100 calls. Well, right now, the market is at 665. And these things expire on Monday, right? So I've got those videos. Again, check out the JPM Collar videos. They go really deep into what these funds do. The first one's very, very simple. You see what they do, why they do it. They provide protection. They look for a way to pay for it. Very, very cool concept. Tends to underperform over time, but that's because of because of things that I explain in many of my programs and cover call videos. It's sort of a challenging strategy, but in any case. And then the second and third parts go into all kinds of other stuff. So you can learn about the Greeks and Vanna and Charm and, the way these things kind of play out as we get closer. Because remember, options react and behave. The Greeks behave through time and space, right? As time moves on, they start to change. And as space, meaning movement, they change as well, right? So there's these multi-dimensional things happening in options, and those videos will help you understand that. So when these calls basically expire a couple of days from now, or a day from now, one trading day from now, these are going to be 100 delta, right? And that means that the market maker is long 100 calls plus short 10,000 shares, because that's what hedges him off fully. These are a full delta, right? These are 100 delta. These are all they're in the money. They have very little time value left. If I'm a market maker, I was a market maker for 15 years. When I was long something like this, I'd be short full stock against this, right? And what does that do? That turns these calls into synthetic puts. Right? Remember, it turns these into synthetic puts. So right now we're well above that strike. And we know that turns into synthetic puts because long stock, why is it doing this? That's pretty annoying. Long stock long calls plus short stock equals long put, right? Synthetic. I could show you that in Thinkorswim. You just add the short stock to it, and then suddenly the thing goes from looking like a call to a downside put. That's exactly what you've done. That's why I always love buying calls from, I did a tweet on that. Everyone screamed at me. I did a tweet. I said, go ahead, sell those calls to market makers. They love buying cheap upside calls because they're going to turn a bunch of them into synthetic puts. And then when the market goes up and those calls were underpriced, they're going to make some money. They're going to turn the rest of them into puts. And then if the market falls, they're going to make a fortune on the puts too. They can't wait to do that. I loved buying calls after a huge run up in a stock because I'm buying cheap calls out of the money. Everyone thinks the stock can't keep going, but guess what? It does. And if I'm nervous, if I get negative, then I can immediately turn some of them or all of them into puts. So you're not forcing the market maker to do anything. They're thrilled to actually buy those calls from you. For all you cover call sellers out there, not saying it's always the wrong thing to do, but trust me, that is one of the great pro trades of all time. I've made a fortune off buying calls from cover call funds, and everyone who thinks they're getting that free money. If you think it's free money, it isn't, and I think you know that after the last 1,000-point run. I see people coming to me going, Hans, please help me. I'm like giving up so much on my performance. Please help me to understand this. And I often say, well, I already told you this. Sometimes you got to keep reinforcing those concepts. So that equals long put. So now what if the stock goes down to 645, right? So we've gone from 665 all the way back down to 645. So now these calls are out of the money. What happens now? Are these calls worth anything anymore if they're going to expire in like 8 hours? Not much, right? Maybe they're worth like 25 cents, 30 cents. Depends how violent this move was. And if volatility doesn't, it's going to go up, but you don't have any Vega in a 6 hour call, barely. So what happens? Well, now let's look at this position. Now the market maker is long 100 calls that are worth basically nothing, but they are short 10,000 shares. And guess what they can buy back? They can buy the 10,000 shares. Hallelujah, they're going to buy 10,000 shares at 645. I mean, the reality of it is they're going to buy it at 650 a little bit, turn those into free calls again. And then they're going to buy some at 648 and they're going to buy some at 646. And you have to have some patience, right? But extraordinary traders are going to be able to wait a little bit longer and understand what's happening. They're going to be able to play those moves. I was actually quite good at the small moves. That was sort of one of my specialties, is really feeling the markets and playing this game to the absolute fullest. So you're going to buy those 10,000 shares back at 645. So now you've lost the $15 that these calls were worth between 650 and 665. You've lost that $15, but you just made $20 on the stock you sold because you sold 10,000 shares at 665. Realistically, you sold them all the way up, but let's keep it simple. You're short 10,000 shares at 65. You lose $15 on those calls that ran up to be worth 15. Those are now worth zero, but you just made $20 on the short stock. So what did you do? Well, you lost 15 and you made 20. You just made $5 on your synthetic put. And let's say these calls expire tomorrow. And then tomorrow, let's say, now what do we have? We're not short stock anymore. We've covered it. But we still have cheap calls. We have our original calls at the 650 level. So what happens now if tomorrow some great news comes out and we go back to 655? Well, I can sell my 10,000 shares again. Boom. I'm gamma trading, right? This is gamma trading. This is scalping to pay your theta, right? This is when you're long options, you have a theta cost. It's not as easy as I make it out because you're battling something. You're battling the cost of these options. But if you buy options at a 21 vol and the market starts to move at a 30, 35, you should be able to make money on that, right? Unless you screw it up somehow. You should be able to make money because it's now realizing more than the cost that you paid. It's now realizing more than the implied volatility that you paid. You paid a volatility that implied 21 movement, but you ended up getting 30, 35 movement. And that means you have put yourself in a position to be able to play that leverage and make more than the theta cost within the price of that option. So I'm going to do a video at some point. I keep saying this. That's going to be something like I made millions from options that I made millions being long options that went to zero. And I think it's going to be kind of cool because people will go, well, what do you mean? How did you make money? Well, like this. The options went to zero, but I made a whole bunch of money trading back and forth. That's what certain market makers do. Now, some market makers trade from the short side. To be quite honest, in my days, I'd say, every 10 market makers, maybe 2 of them played from the short side. Most of them were kind of long players, or at least a little bit more balanced, but leaning long, right? So making sure you're kind of beholden to what the clients want to do to some extent. But you really try to price your options so that you're kind of net buying in the right kinds of environment. Now, when vol goes bananas, then that's where you could probably get a little bit net short. But over my career, I was predominantly consistently probably net long quite a bit of the time, which was great in the 90s and the 2007, 8, 9, 10. Those are the environments where you really want to take advantage of movement. And that's what we do in Leaps Trader, right? We try to take advantage. We don't gamma trade, but although I have a position on right now that does a little bit of that, but we are playing from the standpoint of, listen, we want to take advantage of cheap implied volatility at the longer end. Now that's changed a little bit, as I showed you guys. It's changed in Amazon. It's changed in basically across the board. It's changed. We see some of these little crappy stocks that have gone bananas, and they've gone parabolic. I mean, the vols have doubled in some of them, right? You've doubled your implied volatility. So what I said would happen a few months ago, when I started to show you guys that breakout ratio, looking at the arc versus like I said, this is what's going to happen. And in my next video, perhaps I'll start showing you some of those charts again that make me think that this is, we may have a little bit of a denouement here because we've had a good run, but I don't think it'll be for very long. And I think the mania will probably continue. And I think that's going to create for a heck of a lot of fun in all the things we do. Leaps Trader, Crypto Trader. Crypto's been a little bit quiet lately, but I do believe that it catches on again. So I hope you guys enjoy that. None of this is investment advice. If you think that's kind of cool, how do I do that? Don't jump into gamma trading and start trying it, without learning more about it. And then as always, do a little bit of paper trading, and everything that you do, get that comfort level up, right? Get that confidence going. Confidence is everything in this game. You start small, you build confidence, and you pile on the confidence and add to good positions, right? So, I on this Goldman one, I remember when it was down in the low 600s, and one of our members said, I don't understand. It dropped $30, you didn't add, and then it went right back to its highs and started to make new highs, and now you're adding. Why didn't you add when it was down $30? And I said, because I want confirmation. I don't want to add when the market's telling me I'm wrong. I want to add when the market's telling me I'm right. And that's one of the great things that you can do as a trader, as an investor, is really add to strength in names that you really think. There's no guarantee it's going to work out. But if you keep adding to things that are to a falling knife, you're trying to catch a falling knife month after month after month, that's your account blow up kind of trade. If you're adding to good, strong stories that are continuing to confirm what your thesis is, then you're jumping on a horse that's now out of the barn, as opposed to kind of, looking for a horse in the barn and trying to figure out which one's going to run the fastest. You're jumping on the one that's running the fastest, right? So these are some of the little bits of knowledge that you're going to get in the community and all that. And thank you for all of you. If any of you are on Leaps to Crypto, thank you for joining. We've just really blossomed as a community. It's been just really great fun, and it's going to get better and better. I have a lot of ideas, and so I hope everybody enjoys them. And I'm grateful for your patronage and your support of me to be able to do what I love. So I'll see you guys in the next video, and have a wonderful rest of the weekend.